Now imagine a product so powerful that it can generate profit without producing anything tangible. A product so invisible that most people do not even realize. They are buying it every single day throughout their entire lives. And that product is debt. Debt is deliberately created, refined over centuries, to become one of the most profitable products in human history. Debt has financed wars, brought mighty empires to their knees, bound entire nations into dependency, and quietly drained the wealth of ordinary people. Yet if you ask most people where debt came from, who created it, and why it dominates today's financial system, almost no one can answer. Because the story of debt is not just part of economic history, it is also the history of money and power. In its simplest form, debt is merely a promise. You borrow money today and promise to repay it tomorrow. But hidden inside that seemingly harmless promise lies the essence of financial control. That essence is interest. Charging interest turns future time into a steady stream of profit for the lender. For thousands of years, civilizations have struggled with the concept of debt. Ancient Mesopotamians recorded loans on clay tablets, and on a regular cycle. They wiped all debts clean through mass jubilees. Their rulers clearly understood that if too many citizens were pushed into a corner by debt obligations, the entire social structure would collapse. In the Hebrew Bible, debt forgiveness was mandated every 50 years. The message was clear. Debt is dangerous, and if left unchecked, it can turn entire communities into the bound and powerless. But as centuries passed, the elite stopped forgiving debt and instead learned how to turn it into a tool of power. In medieval Europe, the Catholic Church officially banned usury, meaning excessive interest rates. Yet merchants and bankers found ways around the rules. They disguised loans as commercial contracts or created complex credit instruments that looked like anything except a real loan. By the Renaissance, powerful banking families like the Medici in Florence built their empires not on land or armies, but on lending. They financed kings, popes, and merchants, and in return gained not only wealth, but also political power. Public debt was no longer just a financial product. It became the real force behind power itself. The greatest turning point came in the 17th century, when national debt emerged and rapidly expanded, ushering in an entirely new era, where the power of nations was built and sustained through debt. When the Dutch Republic fought for independence from Spain, it discovered a completely new way to raise money. By selling bonds to its own citizens, any investor could buy government debt, earn regular interest, and even trade those bonds as income-generating assets on secondary markets. From that moment on, war was no longer limited by the gold or silver stored in the king's treasury. It could be extended indefinitely by selling the future through debt. The Dutch perfected this model, and soon after, England quickly followed. The founding of the Bank of England in 1694 officially turned national debt into a permanent and stable system. Instead of borrowing from individual lenders, governments could now borrow directly from a central bank that issued paper money, backed by those very loans. For the first time in history, a government did not borrow only in emergencies, but lived on debt as a permanent condition, rolling it over again and again. The bankers who managed this debt became indispensable to royal power. Debt had moved beyond private contracts and became the foundation of state power. The profits were enormous. For lenders, government debt was the safest bet in the financial world, because the state could always raise taxes. Wars that once bankrupted kings could now be financed indefinitely through debt. And ironically, those very wars expanded territories, opened new markets, and created even more opportunities. It was a perfect loop. The more nations went to war, the more they borrowed. And the more they borrowed, the richer the creditors became. By the 18th and 19th centuries, bond markets in London, Paris, and Amsterdam had become the centers of global finance, where the pulse of world economic power was decided. Armies marched. Ships crossed oceans. Colonies were conquered. And all of it ran on borrowed money. But the story does not end with nations. As industrial capitalism spread, ordinary people were pulled into the debt machine. Railways, factories, and infrastructure were built with credit, financed by bonds and bank loans. Workers were paid by companies that existed because of debt. And then those workers borrowed themselves to buy homes, tools, and eventually consumer goods. Debt seeped into every corner of economic life. By the 20th century, it was no longer reserved for governments or elites. Debt became a mass product, sold directly to the public as an essential part of modern life. It had become a mass-market product, sold directly to the general public, as an inevitable part of modern life. From home mortgages and car loans to credit cards and student debt. Every aspect of modern life was designed to make borrowing the default state. It seemed that to survive and move forward in society, everyone had to enter the cycle of debt. And it is here that the sophistication is concealed. Or more precisely, the system's quiet cruelty begins to reveal itself. Debt does not generate profit just once. Every interest payment is a transfer of wealth, from borrower to lender, from the many to the few, repeated endlessly month after month, year after year. Unlike a product you buy once and use, debt is designed to persist, keeping you locked in a payment loop that almost never ends. A home purchased with a 30-year mortgage can end up costing you twice, or even 3 times the original price. A credit card balance that rolls over month after month can grow faster than your ability to repay. What began as a simple promise turns into a trap. Debt, therefore, is not merely a financial agreement. It is, in reality, a business model, the most successful in history. It requires no factories, no warehouses, and no raw materials. Debt creates wealth using nothing but time. And those who understood this earliest, such as Amsterdam merchants, London bankers, and Wall Street financiers, became the architects of the modern financial system. This system does not merely manage debt. It creates debt, expands debt, and depends on debt to survive. By the mid-20th century, debt was no longer a tool used only in times of emergency. It had become the lifeblood of the entire global financial system. The Bretton Woods Agreement of 1944, often praised as the beginning of a new era of international cooperation, in reality laid the foundations of a global debt order. From this agreement, the International Monetary Fund and the World Bank were created, with the stated goal of lending to countries in crisis, or those seeking capital for development. Yet behind these noble declarations stood a very simple mechanism. Debt became a tool for enforcing discipline on borrowers. They could receive money, but only by accepting the conditions imposed by creditors. The IMF, whose power largely rests with the United States and Europe, began attaching economic restructuring demands to its loans. Entire national economies were told which expenditures to cut, which sectors to privatize, and how to reorganize their budgets. Debt thus became not just a source but a tool of power, used to steer and control borrower nations politically. Countries burdened with excessive debt gradually lost sovereignty over their own affairs. Policies once decided in national capitals were now shaped and rewritten in offices in Washington or Brussels. Much is said about stability and growth, but the reality is deeper dependence. And while national level changes unfolded, another revolution was taking shape inside the everyday lives of ordinary people. In the decades following World War II, banks learned how to sell debt, not only to governments and corporations, but directly to households. Home mortgages became the ultimate symbol of middle-class aspiration. Home ownership, once reserved for elites, suddenly became attainable for millions. The price, however, was signing a contract entire families to 30 years of repayments, a commitment so long, it nearly spanned an entire lifetime. From car loans to installment plans for furniture and credit cards, debt was gradually turned into a consumer product. Marketed like any other commodity, the shift in social psychology was unprecedented. Living on debt came to be seen as entirely normal. Debt was no longer shameful or rare. It became the common way people felt included in shared prosperity. Buy now, pay later. Enjoy today and let the future deal with it quietly became the unspoken slogan of the era. For banks, this was a gold mine. Interest from millions of households generated steady profits that grew exponentially. For governments, it created the illusion of endless growth, as consumption could be sustained through credit, even when wages stagnated. For corporations, debt ensured a steady stream of willing to spend money they did not yet have. Debt thus became the silent engine of modern capitalism. And unlike physical goods, credit can be expanded almost without limit. You do not need mines or factories. All that is required is a signed contract and the power to turn promises into money. But the danger lies here. The entire system becomes addicted to limitless expansion. Banks do not want debts repaid quickly. They want them rolled over, refinanced, and extended as long as possible. The longer borrowers remain indebted, the more profit they generate. Governments soon realize that borrowing is far easier than raising taxes. Politicians can promise benefits today and shift the costs to future generations. Central banks, with their power to create money, made this possible by ensuring constant liquidity, so the system could keep running. Debt was no longer a temporary bridge to overcome short-term hardship. It had become the permanent structure, supporting the entire financial system. And by the 1970s, made this possible by always ensuring there was enough money in circulation to to keep the system running. Debt was no longer a temporary bridge to overcome short-term hardship. It had become a structure, firmly supporting the entire financial system. And by the 1970s and the 1980s, the consequences of excessive dependence on debt had become painfully clear, so obvious that no one could ignore them anymore. During the economic boom, many developing countries in Latin America, Africa, and Asia borrowed heavily. This was largely driven by Western banks, seeking places to channel excess petrodollars after the oil shocks. So they aggressively encouraged these countries to borrow more and more. When global interest rates surged, under Federal Reserve Chairman Paul Volcker, these countries suddenly realized they could no longer repay their debts. And then the debt crisis erupted. In 1980, when Mexico officially declared it could not meet its payments, at that point, the question was what other choice did they have? The solution was to borrow even more, but under harsher conditions. Administered by the IMF and the World Bank, debt became a trap. You borrowed to survive, then borrowed again to repay old loans. And with each such cycle, you lost another portion of your economic sovereignty. Ordinary people faced austerity, inflation, and unemployment, while elites and creditors continued to collect interest. Meanwhile, in developed countries, the financial sector discovered new ways to package and sell the debts themselves. Mortgage loans, car loans, and corporate bonds were bundled into securities that could be traded globally. Debt was no longer just a contract between borrower and lender. It became an independent commodity, sliced up, separated, and sold to investors worldwide. Wall Street moved away from producing goods and toward engineering debt instruments. This process, known as financialization, turned credit into the most important of the modern era. The profits were staggering. A bank could create a loan, then sell it to investors, and immediately move on to the next loan, collecting fees at every step. It was said that risk was widely dispersed, but in reality it was merely hidden, waiting for the next crisis to reveal itself. And the financial collapse of 2008 was the inevitable result. Trillions of dollars in mortgage-backed securities were built on the assumption that Americans would never default en masse, collapsed. Debt had been stretched far beyond reality, and when it snapped, the entire global financial system shook. Governments intervened, not to punish those who sold toxic debt, but to save them, once again revealing who the system was truly designed to serve and protect. While ordinary families lost their homes, their jobs, and their life savings, banks received bailouts. And when things temporarily calmed down, the use of debt did not decline, it surged even further. The crisis created by debt became the justification for injecting more debt through central bank intervention and ultra-low interest rates. At this point, debt was no longer just a source of profit, but an indispensable element. Every part of the global economy depended on it. Governments used debt to cover deficits, corporations borrowed to buy back shares, and households relied on debt to maintain living standards. Without continuous borrowing, the entire system would collapse. Debt had become the product that sustained everything else, a commodity that could be traded repeatedly, rolled over, and inflated without limit. This is the perfect business model because it requires no innovation, no raw materials, only borrowers who continue to believe, and governments that keep protecting the system. After the crisis of 2008, central banks cut interest rates to near zero and flooded the system with liquidity, promising that this extraordinary medicine would restore stability. But in reality, it only makes debt addiction even worse. Cheap credit has encouraged governments, businesses, and individuals to borrow even more. The current figures are hard to believe. Total global debt has surpassed $300 trillion, more than 3 times the total value of the world's annual economic output in a single year. Never in history has humanity been so deeply in debt, and most of it is owed to a small group of people. Ironically, this mountain of obligations is praised as a form of growth. Politicians point to rising GDP figures, fully aware that much of it is simply borrowed from the future. Debt has become so normalized that we hardly question it anymore. A 20-year-old carries tens of thousands of dollars in student loans, and the debt is sold to them as an investment in their future. A couple signs a 30-year mortgage, marketed as a dream come true. Governments run persistent budget deficits year after year, and voters barely notice because the consequences are not immediate. Inflation is the hidden tax that makes debt repayment possible, quietly eroding the value of money in people's pockets while preserving the nominal power of the debt system. What looks like prosperity is often just leverage stacked upon leverage. Yet the profitability of debt is at its highest level in history. Banks do not just earn interest on every loan. They have built an entire industry around debt services such as refinancing, debt collection, and restructuring. Investors make fortunes trading government bonds, betting on the repayment capacity of entire nations. Hedge funds invest in distressed debt, profiting from the exhaustion of bankrupt states or struggling companies. Credit rating agencies, once seen as neutral arbiters, have become gatekeepers deciding who can borrow cheaply and who must pay higher interest rates. Debt is not just a financial product. It is a marketplace where promises are priced, traded, and exploited. The most striking feature of this entire system is how it concentrates wealth. Every interest payment is a transfer of assets from borrowers to lenders. Over time, this flow moves upward, from millions of households paying off credit cards and mortgages into the balance sheets of major banks and massive investment funds. It not only generates profits, but reshapes society, locking in inequality. Those with assets can borrow cheaply to acquire more, using leverage to turn wealth into greater wealth. Those without assets must borrow at high cost, trapped in a cycle of perpetual repayment. Debt becomes a mirror reflecting class divisions, polished and legitimized by the financial system itself. And now, as central banks begin exploring central bank digital currencies, the next version of debt is emerging on the horizon. Imagine a programmable form of money, tracked and controlled at the code level. Loans could be approved or denied automatically by algorithms. Interest rates could change in real time and penalties applied instantly. For many, this may sound efficient. But if the history of debt teaches us anything, it is that efficiency, for creditors, always means borrowers lose some degree of freedom. The most profitable product in history is being upgraded to enter the digital age. And once again, it will be designed in conferences and committees, out of public sight. So what is the lesson here? Debt is not neutral. It is not a simple tool for progress, nor a natural feature of modern life. Debt has been deliberately cultivated to become the most profitable product humans have ever created. A product that turns time itself into money, turns individual hope, and the effort of entire nations into steady streams of interest flowing upward. To understand debt is to understand that financial freedom is never given by the system, because the system exists by keeping you indebted. True wealth begins with reducing dependence on borrowing, questioning promises of easy credit, and realizing that behind every loan offer, there is always a machine designed to profit from your future. History does not repeat itself exactly, but the patterns always remain. From Mesopotamian clay debt tablets to suburban mortgages, from Dutch bond markets to Wall Street derivatives, the story is always the same. Debt enriches creditors, burdens borrowers, and reshapes the world to benefit those who control the flow of money. And the cruelest part is that we are taught to celebrate it, to call it progress, and to mistake borrowing for prosperity. If this analysis makes you see debt from a different perspective, subscribe to the channel to not miss upcoming videos about how the financial world truly works. Share this video with anyone who still believes that debt is harmless, and let me know in the comments what surprised you most about this system.